Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
Oh, it's going all right, Will. How are you?
Doing okay. Back in my sister's, work area, her studio once again. And Ben, it looks like you're just floating in the ether. Where are you at?
Yeah, yeah. So I'm at my mom and dad's. This is their dining room wallpaper behind us. But this is the best I could do today. So this is what you get.
Well, we're doing. I guess this is the Christmas episode for WCMU. So Merry Christmas to all if you're watching us on or around Christmas Day. Well, I guess this would be released right after Christmas Day. So Merry Christmas, Merry late Christmas. But anyway, Ben, as we move forward, I want to jump right into today because we have some economic discussion when it comes to the U.S. dollar and what that might mean moving forward as we look into the 2024 economy because that's just around the corner. Real quick, I want to give some commodity updates. That nearby corn contract, that March 24 contract, is up on the day at 473 close. Soybeans for January closed today at 12.99, so up a little bit there. And then the nearby wheat contract for March 24 closed at 616 and a quarter. So been some slight gains as again, not a lot of things heavy in the news cycle to talk about, a little bit of South American wetness. But a positive day at least, although we have seen a downward trend slightly on the week.
Sure. We're just in a transition period here this week. People are getting ready for the extended holiday weekend. Not a lot of volume that has potential to create some moves in the market.
So, Ben, we kind of teased this before we really got rolling today, but looking ahead to 2024, I think it's going to be interesting to watch the timing of what the Fed does, maybe backing off on some of these interest rate hikes, maybe starting to slow that down and peel those back. But just to give a recap of what we've seen over the last year and a half or so, dating back to July of 22, I want to give a snapshot of the inflation rate month over month. So in July 22, we just barely passed 9% month over month. And then, in that year and a half, we trimmed down. So by March of 23, it was down to 5%. June of 23 down to 3%. And then we still kind of hold steady around that 3% mark as of our last update in November. The US dollar index, it's weakened from 107 to 101 there in that time. And then the interest rates have jumped from 1.5 to about 7% in that time frame. So, Ben, it seems in the last year and a half, the Fed's objectives have mostly been met when it comes to raising those interest rates, trying to tamper the inflation rate, and try and control maybe the U.S. dollar index for trade there. So, what do you foresee, I guess, moving forward as we think about where we sit in the general economy and the power of the U.S. dollar?
Well, one, this last percent and a half here that the Federal Reserve is trying to lower inflation is going to be the hardest to get. It's no different than when you're moving goods. The most expensive part of transporting a product is always what we call the last mile. It's the same thing with research papers. What have you? You could pick whatever you want. The hardest part is always the very end, because that's when you've accomplished all the low hanging fruit, or the fruit that's on the ground that you just got to go out and pick up, right? Like, uh, that's all easy, and you can do that relatively quick. But to really get the inflation rate down to where the Fed would like it is going to take a lot of discipline. It's going to take some time. I think I think that's going to be more challenging than what the general market is currently anticipating. So I guess I'm giving maybe a little bit more of a pessimistic view than what many people would like for me to say. But wage rates, rental rates, housing rates, those are all starting to heat up again. We've seen some pretty aggressive labor negotiation contracts. We've seen, our hourly pay continue to be stubborn as we work down. Of course, that just feeds into the general economy. So I think the Fed has still got its work cut out for it to get inflation down the remaining 1 to 1.5% that we need to go here to get to that 2% inflation target.
And it is kind of interesting, for my, I guess, portion of adult life, you've always heard that 2% is kind of that sweet spot that's targeted. And, Ben, using your analogy, thinking about how that works, when you're charging a battery, the 0 to 80% charge takes about the same amount of time as that 20 to 100% charge. So what do you expect? How do you expect this to maybe be handled? Does this mean just holding those elevated interest rates where they are, or does this mean adjusting them further as we look into 2024?
Well, so I think the Fed will hold longer than what the market is currently anticipating. The market is currently anticipating the first rate cut to come in the March meeting, and with the expectation of 3/4 cuts, or excuse me, 1.5% cuts on that short-term federal funds rate. So, three, I guess, half-point cuts in 2024. I think that's optimistic, right? Like, it is an election year. There's a lot of things that could cause that to actually happen. There's reason to believe that it could happen, but that's not what the Fed has been telling us.
Mm,
The Fed has constantly said to be prepared for higher rates for longer periods of time. Now, when they came out with their quarterly update last week, it did include the expectations of the members themselves, and there was at least some members that are ready to make interest rate cuts, and the market read those and reacted to those strongly. And we've had, 6 straight days here that the Dow Jones Industrial Average has set a new all-time record. Cooled off a little bit as we headed into this holiday weekend, but
yeah,
that has been very strong, and we've seen consumer confidence surge.
yep,
Um, and again, it's one of those things. I don't know how else to say this, but expectations are powerful, and the Fed is managing an expectations game. At games, maybe they're not right word, because these are people's lives and this is a livelihood, and there's the statistic out there that every percentage point increase in unemployment, or the unemployment rate, leads to so many deaths and stuff like that. So this is a very serious thing. But what I'm trying to say is the Federal Reserve has to break the psychology of inflation. They've done they've brought it down, as you've mentioned, and those year-over-year percentages, and it's slowed, but this last go is going to be very hard, and that's why I think the Federal Reserve is going to err on this side of caution and keep
yeah.
those rates higher for longer, and the market's going to be disappointed that at some point in the future.
Well, and if you pay attention to what's been going on for the last year plus, really that the Fed has been methodical about how they've gone about this. They've had these incremental increases that have been fairly consistent, and you'd imagine, just on their track record, they would err on the side of caution and hold off longer, just to make sure that they don't pull back too soon, and you see interest rates, or not interest rates, excuse me, that inflation rate stay elevated or above where they'd like it to see. So Ben, sometimes, it's hard to see within agriculture the direct correlation of this, but the interest rate directly does tie into how that impacts the power of the US dollar, which then by extension impacts the how trade occurs. So as you see that value of the dollar inflate, it causes some higher prices, or it being more expensive to buy US products. So as we see that dollar value track a little bit downward, will this impact the U.S. Ag economy in any immediate way when it comes to maybe increasing some trade?
Well, just in a mathematical exercise, we would say yes, a lower dollar does help facilitate stronger ag exports, or any commodity or any product that is exported out of a country, right? Like, it just happens that the US is a major exporter of grain. So that's why we talk about a strong, or, a weakening dollar being supportive of more exports. However, I'll remind folks that it's the US dollar relative to other currencies. We're seeing some interesting things happen in South America with the Argentine currency, the Argentine peso. There's been times where we've seen some of the other major economies around the world that we trade with as buyers, so that their currency is fluctuating as well. So, it's not just ours. It certainly plays a role in that. And yeah, I would assume that as price moves down, we do see a little bit stronger of an ag export market as well.
Well, and Ben, it kind of comes almost at an awkward time because you're starting to see that South American market heat up, and watching the weather patterns down there. So it will be kind of interesting to see what impacts we might see from trade. Now, Ben, as we look forward into this week, it's kind of an interesting week between Christmas and New Year's. So what should farmers and ranchers really be paying attention to when it comes to things that could move the market, even though we've been in a lull for a couple of weeks now?
Yeah, so it is going to be kind of a slow moving week. Everything will be delayed because of the holiday on Monday, the Christmas holiday on Monday. So everything will be delayed. I don't look for anything to be shocking as we look ahead. Um, I am intrigued to see U.S. export data here over the next couple of weeks. We've talked about the dollar, but really it's the sales that we have on the books. Can we turn those into actual physical shipments? Because for soybeans, our window is starting to close. I mean, we're getting closer and closer to that point where that window is starting to close. So I'm probably most interested in the export reports, both the inspections on Tuesday and then the sales data to come out Friday morning. I think that'll be probably the thing that I'm most interested over the next couple of weeks.
All right, Ben, always great to have your brain onto the program and to get the information that it can provide. So, as we move forward, viewers and listeners, if you'd like to learn more about us, what we do, or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.